Welcome back to the deep dive. Today, we are opening up the financial mechanics of corporate reporting to tackle a really fundamental question. When a company's financial statements change, is that change an evolution or is it an admission? If you're an investor, an analyst, or, just someone trying to understand what you're actually looking at when you compare 2 years of a 10K, this is your deep dive. The core struggle is distinguishing between a simple, legitimate shift in judgment and a serious, mandatory correction of a mistake. We're really asking, are we preserving history or are we rewriting it?
That's the essence of the problem. Comparability is everything in financial reporting. If one year's net income is calculated using a different set of foundational rules than the previous year, then the comparison is, well, it's useless. These rules are the roadmap that dictates whether your prior year's financial results, stands fixed or whether it must be retroactively adjusted.
And the regulatory bodies, specifically the FSB, that's the Financial Accounting Standards Board here in the US, they've divided these shifts into 4 distinct types of events. Understanding which event applies dictates whether they adjust the past or just, move on.
Exactly. We're going to categorize every potential shift.
Yeah.
We're talking about 1, a change in accounting principle; 2, a change in accounting estimate; 3, a change in reporting entity; and 4, the most serious one, a correction of error.
Okay, so let's start right there with the core difference between a principle and an estimate. What are we talking about? A change in accounting principle is about changing the core operating rule, right?
Yeah.
This is the adoption of a generally accepted accounting principle. We call it GAAP. That's different from the one you used before.
Right.
So like changing the method you use to value your inventory. You're changing the fundamental framework.
And in stark contrast to that, you have the change in accounting estimate. I mean, financial reporting is just full of managerial judgment. Estimates are required because we don't know the future perfectly. An estimate changes because management gets new experience or new information becomes available. You're not changing the rule. You're applying better insight.
So things like estimating the useful life of a new machine or the percentage of accounts receivable you expect to turn into bad debt, the world changed. So your best guess changes.
And that leads us to the critical distinction: the correction of error. This is not an accounting change at all. It's an admission that the numbers were just wrong from the start.
An oops, but a major regulatory oops.
Precisely. Errors include correcting mathematical errors, misusing facts, or, major oversights. And crucially, if a company discovers it was using an accounting principle that was not generally accepted and switches to one that is, that's an error correction, not a change in principle.
Oh, that's interesting. So they were non-compliant and now they have to fix it.
They were non-compliant. And the insight here is crucial for you, the listener. An estimate change is driven by new information. The old numbers were correct based on what you knew at the time. An error correction means the old numbers were always wrong. One protects history, the other destroys it.
And our last one, just to round it out, is the change in reporting entity.
Right, this one's pretty simple. It just means the group of companies being reported changes, usually when a parent company buys a new subsidiary and starts presenting consolidated statements.
So we have our 4 categories. Let's talk about the impact on the books, starting with the 2 that require that heavy lift of rewriting history.
When it comes to a change in accounting principle, the rules are ironclad. The retrospective approach is required.
What does that truly mean, though? Did they just add a footnote explaining the change?
Oh, it's far more than that. It means every single prior year's financial statement presented has to be restated as if the new principle had been in effect all along. This is a complete revision of the past. And on top of that, the cumulative effect of that new principle has to be reported as a very specific adjustment. It goes to the beginning balance of retained earnings, or in some cases, AOCI of the earliest year presented. You are literally retroactively adjusting the profit the company has earned since day one, just to align with this new rule.
So the retrospective process is essentially designed to remove all that historical bias and make those numbers perfectly comparable no matter the administrative headache.
Exactly. And we have to separate the direct effects, the adjustments needed to change prior statements, from the indirect effects.
What's an indirect effect?
So for instance, if that inventory method change results in a different management bonus calculation, that change in compensation is an indirect effect. Those are only reported in the current period. You don't go back and restate those.
Wait, if the general rule is retrospective, is there a risk that companies might delay implementing a new, better principle just to avoid that massive, costly restatement effort?
That risk absolutely exists, which is why the FASB set the bar for avoiding it incredibly high. You can only avoid retrospective application if it's deemed, and this is the specific term, impracticable.
Impracticable, that sounds like a legal concept. How do you prove something is impracticable?
You basically have to prove it's conceptually impossible. There are three conditions, but they boil down to two big hurdles. First, you can argue it if the data you need to restate the past simply doesn't exist anymore. You've made every reasonable effort, but the information is just gone. The second hurdle, and this one is maybe more interesting, is when the restatement requires assumptions about what management's intent was in a prior period, and you can't independently substantiate that intent. You can't just guess what managers years ago would have decided under this new rule. It prevents hindsight bias.
That makes it almost impossible to avoid unless the paper trail is, fundamentally missing or flawed. And what about companies that report quarterly?
The consistency holds. If a change in principle is made in an interim period, say Q2, then all prior interim periods of that year, plus all prior years presented, must be retrospectively adjusted. The cumulative effect still hits that opening retained earnings balance. Every single reported period has to be comparable.
Okay, this brings us to the nice, clean opposite, the change in accounting estimate. If principal changes require rewriting history, estimate changes let history stand.
They're so much simpler. Changes in accounting estimates are handled entirely on a prospective basis. They affect the current year and all future years. And the crucial takeaway here, prior financial reports are absolutely not revised. They are based on the best judgment at the time, and that history stands.
Let's use the Alpha Company example from our source material to show why this matters so much for analysts.
Okay, so Alpha Company had an asset for $75,000, and they initially estimated a 10-year life. After 3 years, based on usage, wear and tear, management realizes, uh-oh, that was way too optimistic. The asset really only has 3 years of life left.
So they don't go back and restate those first 3 years, even though the judgment was, well, wrong. Instead, you take the remaining cost, the book value of $52,500, and you spread it over the remaining 3 years.
Exactly. The depreciation expense immediately jumps from $7,500 a year to $17,500 a year.
Wow. So Alpha's current year earnings take a significant, immediate $10,000 hit, but the past remains untouched. And that volatility is something analysts have to look out for because the prospective approach gives management a lot of control over current year earnings.
It separates managerial judgment from rule changes. The judgment evolves, but the historical results based on the best info at the time are, well, they're protected.
Do companies have to call out every single time they change an estimate, like when they adjust their expected bad debt?
Generally, no. For routine estimates that recur normally, like bad debt or inventory obsolescence, they don't require specific disclosure unless the change is highly material and affects multiple periods in a big way. If it's just a normal refinement of judgment, you usually won't see a separate disclosure.
Okay, now for the classic trap scenario. Part company changes its depreciation method from straight line to double declining balance. That sounds like they're changing a rule, a principle.
It certainly feels like it, but the accounting standards treat this scenario with a specific exception. The rule specifies that a change in depreciation, amortization, or depletion method must be reported as a change in accounting estimate.
That's a major carve-out. So even though they changed the formula, it's treated like an estimate change, meaning part company would not restate its prior financial statements.
Correct. It ensures that changes in how management measures wear and tear are seen as evolutions of judgment, not as rule changes requiring a massive historical adjustment. The prior years stand firm. It's a key distinction.
Okay, so if estimates are evolving judgment and principles are changing the rules, then errors are just that dreaded oops. Let's look at how the biggest oops moment, a restatement, actually works.
When error is discovered, the FASB requires a complete restatement, which is, equivalent to the retrospective application we just discussed. When you have to issue a restatement, that is probably the biggest red flag you can wave in the financial world. It's management saying, we missed something fundamental.
And just like a change in principle, the cumulative effect of that error has to be reported as an adjustment to the opening balance of retained earnings of the earliest year presented. Let's look at the Omega company scenario without getting too bogged down in the exact math.
Okay, so Omega incorrectly expensed a $70,000 asset in 20X1 that should have been capitalized. This one error messed up multiple years. 20X1 expense was massively overstated, and then the following year's income was understated because they missed out on the depreciation expense.
So when they fix this on January 1st, 20X4, the entry is dramatic because they have to put the asset back on the books and correct every single year that was affected.
That one entry requires them to debit the machinery asset for $70,000, credit accumulated depreciation for the 3 years of missed depreciation, and then, after you account for taxes, they credit the cumulative effect of the error right to retained earnings. It's a complete, literal correction of history in one big journal entry.
Making the prior year's numbers finally reflect what should have been on the books all along.
Exactly.
Okay, let's turn to our final classification, changes in reporting entity. When a company decides to consolidate a newly acquired subsidiary, what's the rule?
This also requires the retrospective approach. If the group of companies making up the reporting entity changes, all prior years' financial statements have to be restated as if the new consolidated group existed during all those prior periods.
So, if a giant tech company acquired a major new subsidiary last year, when they publish their current year results, their comparative data for all the prior years has to look as if that subsidiary was always part of the family.
Precisely. It ensures that when you compare last year's revenue to this year's revenue, you aren't fooled by the simple addition of a new company. You have to have that apples-to-apples comparison to gauge any real growth.
Before we close out, our sources also briefly touched on contingencies and commitments. These feel related to judgment, but they're distinct from the other four.
Good critical disclosures, yeah. A contingency is defined as an existing condition or situation involving uncertainty about a possible future gain or loss. This is the stuff that might happen: the collectability of a major receivable, or the future cost of product warranties. Management have to use judgment to predict those outcomes and disclose them correctly.
So to synthesize everything for you, the listener, we've established the difference between a change in practice, that's the principle, a change in judgment, the estimate, and a correction of a mistake, the error.
And that distinction is crucial because the stakes are so high. Retrospective restatement, whether for principal changes or error corrections, means the numbers you are looking at today are exactly what those past numbers should have been. Prospective application for estimates acknowledges that judgment evolves, and that prior history, while maybe imperfect, it stays fixed.
It all comes down to preserving or rewriting the past, and which of those actions carries the greater consequence for market trust.
And that leads to a provocative thought for you to explore. Considering that both error corrections and principal changes require the dramatic and often damaging step of restating history, and knowing how sensitive investors are to seeing large retroactive retained earnings adjustments, what level of evidence must management realistically present to auditors to successfully argue that retrospective application of a new principle is truly impracticable, and thus avoid adjusting all those past financial reports? The incentive to declare history conceptually impossible to recreate, it must be enormous.